Stories of how the Tesla stock price will crash and burn are nothing new to investors of the leading electric vehicle brand. It's been said over and over that the company is wildly overvalued. Skeptics have had a field day recently with the stock price in a steady decline from its glory days and seem to have been proven correct, but we believe this is just the storm before the calm. What has been driving Tesla's stock price down? How long will the stock price continue to go down? When will the stock prices start increasing again? Keep watching to find out. In March 2021, following multiple negative stories and Ford Motor Company's debut of a powerful electric pickup truck, Tesla Incorporated shares hit a low point, plummeting for the fifth week in a row. The stock finished the week at $588, down 1.5%. It was the company's worst weekly losing streak since March 2018, as investors shied away from risky companies amid rising fears about inflation and its influence on the US economy, as well as some severe COVID-19 outbreaks in several countries. It seems to tell us that history is repeating itself as extreme circumstances are again at play and affecting market sentiment once more. Tesla's stock has had a difficult year thus far. The stock has lost more than 18% year to date, and this difficulty cut across most growth stocks. This year, growth stocks like Tesla have seen a lot of volatility as investors consider the implications of the Federal Reserve's projected interest rate hikes. Higher interest rates are generally regarded as less favorable for assets, with valuations based largely on long-term cash flow expectations. With a price-to-earnings ratio of 176, Tesla surely qualifies as a growth stock. While a falling stock price usually signifies trouble in paradise, experts say there's really nothing to worry about. The business is reportedly thriving. Investors should keep in mind that Tesla's business has recently grown at a breakneck pace. Despite an extraordinarily difficult market for automakers, fourth quarter deliveries increased by 71% year over year. And even if Tesla's two new plants don't work smoothly, management forecasts a 50% increase in vehicle deliveries this year. These reasons may help to justify the stock's high price tag. So why is the stock price still down? Depends on who you ask. There are still numerous perspectives to this, including Tesla's recent problems with autopilot crashes, quality control issues such as seatbelt recalls and phantom braking, a price-to-earnings ratio of nearly 300, and the inexplicable disbanding of Tesla's public relations department. There's also the continued expansion of competitive products in the United States, particularly in Europe, where competitors outsell Tesla by more than 3 to 1. Investors seem to be losing faith in CEO Elon Musk and asking some important questions. Is Tesla on track to meet its 3-year targets? And can it continue to outperform competitors in the electric vehicle industry in the future? It must not only compete with additional competitors, Lucid, Rivian, and so on, but it must also increase its profitability. This may be a tougher challenge than flourishing in a new market it controlled up until recently. In Europe, it's already being outsold by Volkswagen in the EV market, as indicated in the graph below. How long will Tesla stock continue to go down? It's important to note that the causative factors of the declining stock have almost nothing to do with the actual business operations and profit. It's true that the stock price took a hit when Musk announced the delay of Cybertruck as well as full self-driving technology, but other than that, the business is actually thriving. The drop was also fueled by a broader sell-off in high-growth, high-multiple firms as investors prepared for tighter monetary policy and higher interest rates this year. It seems to us that its major external factors are the driving force in these circumstances, and Tesla's stock price will only stop going down once these factors are alleviated. Just what are these factors? To name a few, the well-known chip shortage, resistance and skepticism on the Berlin Gigafactory, fear of hiked rates by the Federal Reserve, and the effect of the Russia-Ukraine situation. The chip shortage problem doesn't seem to be going anywhere soon, but Tesla seems to have a handle on this. According to 2 Tesla employees and internal correspondence seen by CNBC, under pressure to meet sales goals while dealing with widespread semiconductor shortages, the company decided to remove one of the 2 electronic control units that are normally included in the steering racks of some made-in-China Model 3 and Model Y cars. The exclusion, which has already affected tens of thousands of vehicles being shipped to customers in China, Australia, the United Kingdom, Germany, and other parts of Europe, was not disclosed by Tesla. The omission suggests that Tesla had to make some changes beyond what it had previously disclosed in order to keep its factories and sales running from the final weeks of 2021 onwards, as the world faced an ongoing chip shortage that impacted everything from cars to laptop computers. It also means that Tesla won't be able to convert all of its existing cars to self-driving cars with just a software update. However, we believe that for the company to have implemented this line of action, they would surely have a plan to tackle potential issues that might crop up in the future. The Berlin Gigafactory is finally a go, and perhaps spells a future hike in the stock price. Tesla has begun construction on the project, which will include a battery plant capable of generating more than 50 gigawatt hours per year, considerably beyond European competitors. While batteries for on-site cars would initially be sourced from China, Musk claimed that he intends to attain volume production at the German battery plant by the end of the next year. According to media reports, the company expects to invest up to 4 billion euros in the project, which will create 500,000 battery-powered vehicles every year. However, in a note to investors, Morgan Stanley warns that the journey might not be as smooth as we anticipate. Clients were told in the note that Giga Berlin's story isn't just about Tesla's expansion, it's also about German workers and growth. With great progress comes a certain amount of complication. We'll have to see how this plays out, as its success is very important to the growth of the stock. We believe it's nothing Tesla can't navigate effectively to their favor. The fear of inflation is another factor that's making investors wary. According to Fed Chairman Jerome Powell, who told CNBC in an interview that further near-rate hikes are needed to contain domestic price increases, inflation is broadening and accelerating in the economy. The Federal Reserve's predicted interest rate hikes are worrying for some investors, but experts say that this isn't that much of a cause for concern, as stocks should in principle give some inflation protection because a company's sales and earnings should grow with inflation after a period of adjustment. If anything, it's more reason to invest, and once this dawns on more people, we can expect more investments. The Russia-Ukraine situation is the last issue we'll be tackling today. Since Russia is one of the major suppliers of oil, and since a good number of countries' leaders have sanctioned them, this is sure to impact exports. Fear of an imminent world war has sparked fear amongst investors. However, the fact is that in reality, it's not been all that bad, at least for Tesla. Oil prices rising will surely drive a shift towards electrification and increase demand for electric vehicles. Tesla and other electric vehicle producers' stocks have skyrocketed according to AAA.com, while gasoline costs have risen to a national average of $3.61 in the United States. Many experts advise people to take this opportunity and actually buy the dip while they can, because they foresee a rebound soon. After all, we mentioned how low the stock prices dropped in March 2021 due to external circumstances and events occurring at the time, and Tesla went ahead and had their stock price peak later that same year. As the issues we've tackled get resolved or turn around in Tesla's favor, the stock price is bound to rise. Most importantly, Tesla's first quarter earnings call is coming up soon, as the quarter ends next month, and is sure to dispel doubt as analysts predict stellar results, even better than last quarter's. According to analysts, the stock has a 60% chance of gaining in the coming month. This is when we believe the stock price will stabilize and start to actually climb back up. To conclude, we give it about a month, and in the coming months, we believe there will be accelerated growth in line with the company's goals for the year. How long do you think Tesla's stocks will continue to decline? What do you think is causing the stock price to go down? Comment down below.